Hello everyone, my name is Alice Pandolfo Marques and today I'll be presenting my master thesis titled Elevator Up, Stairs Down, Integrating Disruptions in Container Shipping Freight Rates Forecasting. This research was conducted under the guidance of Professor Munim at the University of Southeastern Norway, and I'll walk you through the motivation, methods, results, and contributions of this work. Container shipping plays a vital role in the global economy. It connects production in Asia with consumption markets worldwide, making freight rates a key cost for manufacturers, retailers, and freight forwarders, for example. However, these rates are highly volatile, influenced by structural factors like fleet capacity and fuel prices, and increasingly by disruptions such as COVID-19, Red Sea attacks, or port congestion. This volatility complicates pricing strategies, budgeting, and contract negotiations for businesses. For example, a freight forwarder offering quotes to clients can face large losses if market rates spike unexpectedly. The phrase elevator up, stairs down captures the asymmetry. Rates rise quickly in response to shocks, but fall slowly and unevenly. This makes forecasting both essential and difficult. Accurate freight rate forecasting is critical for stakeholders. It helps with budgeting, hedging, and planning. Traditional models like ARIMA or VAR rely on historical trends and assume linearity. They often struggle during disruptions like COVID-19 or geopolitical shocks. Moreover, many existing models fail to include disruption-sensitive variables, such as geopolitical risk indexes or port congestion, which are crucial for capturing short-term volatility. That brings us to the central research gap. We need more flexible, data-driven forecasting tools that can integrate a broader set of variables, both structural and disruptive, and adapt to sudden market changes. Machine learning models are well suited for this. They can capture nonlinear patterns and interactions that traditional models miss, and are better equipped to deal with high-dimensional data environments. To support my research, I conducted a systematic literature review using Scopus, and I structured it in 3 separate targeted searches. The first looked at general drivers of freight rates, including economic, supply chain, and geopolitical factors, and yielded 114 articles. The second one focused on forecasting methods applied in maritime transport, while the third one targeted machine learning approaches in shipping. After filtering and screening, I selected 16 core articles. These covered a mix of traditional models and machine learning models such as neural networks and SVMs. A clear pattern emerged. Few studies integrated disruption-sensitive variables. This confirmed a significant gap and shaped my thesis objective: to develop a machine learning forecasting framework that includes both traditional market drivers and real-world disruptions. The core objective of my thesis was to develop a machine learning forecasting framework that incorporates both traditional and disruption-sensitive variables. These include macroeconomic indicators, port congestion metrics, and geopolitical risk, all of which are known to influence freight rates, especially during volatile periods. The forecasting target is the China Containerized Freight Index, or CCFI, which tracks shipping rates on the Asia-Europe trade route and serves as a reliable industry benchmark. Having identified the gap in the literature, I structured my research around 2 research questions. The first one is what are the major factors, including disruptive ones, that influence maritime freight rates? To answer this, I combined insights from the literature review with SHAP analysis after training the machine learning models. These revealed which variables had the strongest impact on the CCFI. The second research question is which machine learning model performs best in forecasting container shipping rates. I trained 6 supervised models and evaluated their performance using standard metrics, RMSE, MAPE, and R-squared. These 2 questions shaped the methodology and analysis, helping align model performance with both theory and practical relevance. This study followed a quantitative deductive design aligned with a positivist paradigm, assuming that relationships between variables can be objectively observed and modeled. In line with this, I applied supervised machine learning to build a forecasting framework for the CCFI, using monthly data. A key design choice was applying a 3-month lag to all predictors. This reflects how external shocks, like interest rate changes or port congestion, take time to impact freight rates. This lag structure mirrors real-world forecasting conditions, where decision makers predict based on past data, not future knowledge. The dataset was sourced from Clarkson's research and the Geopolitical Risk Index by Caldara and Iacoviello, covering 2016 to 2024. Initially, there were 51 variables, including the target, the CCFI. I removed those with missing data, reducing the set to 44. Then I applied log transformations to variables like TEU volumes and ship sales to reduce skewness and stabilize variance. To refine the dataset, I conducted a Pearson correlation analysis, filtering out predictors with weak correlation to the CCFI and those causing multicollinearity. In cases of strong correlation, where R was greater or equal to 0.9, only one variable was kept. The final dataset included 30 independent variables, each statistically relevant and aligned with key freight market factors, such as demand, supply, port congestion, and geopolitical risk. These became the inputs for the machine learning models. I tested 6 machine learning models, each offering a different approach to forecasting. Linear regression was used as a baseline. Fine tree was used to capture nonlinearity. 2 support vector machines were used, one linear and one with Gaussian kernel. A boosted tree ensemble was used for improved pattern detection. Lastly, a 3-layer neural network was used for deep learning capability. All models were built and evaluated using MATLAB's Regression Learner app, ensuring a standardized process. This diverse selection allowed me to compare not just accuracy, but also interpretability, computational complexity, and how each model responds to different types of inputs. To assess the performance of each forecasting model, I used 3 evaluation metrics, each offering a different perspective on error and explanatory power. RMSE was used for error magnitude, MAPE was used for percentage-based error, and the R-squared to assess variance explanation. Each model was tested using 3-fold cross-validation, which rotates training and testing across 3 subsets. The table shown in the slide provides a comprehensive summary of these results. As you can observe, the linear SVM model provides the best metrics. Its RMSE is 663.7, R-squared of 0.8, and MAPE of 25.6%. Its prediction speed was 6,300 observations per second, training time of 2.75 seconds, and size of 29 kilobytes. This slide shows how each model performed across the full range of CCFI values. The linear SVM showed the most stable performance, closely tracking actual rates even during volatile periods. This is the picture presented on the right side of this slide. The neural network captured trends well, but showed higher variance at extremes, making it less reliable in stress periods. The boosted trees model followed general patterns, but smoothed over sharp peaks and troughs. The linear regression underperformed in high-rate periods due to its inability to model nonlinear dynamics. The fine tree and SVM with Gaussian kernel were inconsistent, especially at extremes, showing erratic or noisy predictions. These visual results reinforce the quantitative findings. Linear SVM provided the best combination of accuracy and robustness. To interpret model predictions, I use SHAP values, which explain how each variable contributes to a prediction consistently across different models. In the linear SVM that performed best, presented on the right side of the slide, its top predictors included the lagged CCFI, the total container ship sales in million USD, China interest rate, port congestion index at Antwerp, values of TEU. This confirms the influence of past freight levels, macroeconomic indicators, and port congestion. Other models showed similar trends, although with variations. The boosted trees and neural networks also emphasize congestion and contracting activity. Models like Fine Tree and SVM with kernel produced inconsistent rankings, reflecting their lower predictive reliability. Overall, SHAP analysis validated the relevance of the selected variables and reinforced why disruption-sensitive factors matter for accurate forecasting. After comparing all 6 models, the linear SVM stood out as the best performer. It combined strong accuracy with consistency across both stable and volatile periods without overfitting. The SHAP analysis also showed that its predictions align well with the theory and practice, emphasizing variables like the lag CCFI, interest rates, and port congestion. While models like neural networks and boosted trees captured trends, they were less reliable at extremes or over smooth sharp market changes. This shows that effective forecasting doesn't always require the most complex architecture. A well-tuned, interpretable model with the right inputs can deliver excellent results. The findings support the use of machine learning in the maritime forecasting and highlight the value of integrating disruption-sensitive variables. After selecting the linear SVM as the final model, I tested its forecasting capability on completely unseen data, covering January to March 2025. As shown in the table, the model initially overpredicted the CCFI quite significantly. For example, in January 2025, it forecasted 3,168.3, while the actual was 2,004.3, resulting in a 58% error. However, this error decreased steadily over the 3 months. By March, the prediction was 2,834.4, compared to an actual value of 2,181.5, reducing the percentage error to just under 30%. This trend suggests that while the model may struggle with sudden shifts or short-term market corrections, which aren't fully captured by lag variables, it begins to adapt as more recent data patterns stabilize. This is a valuable property for freight forecasting, where external shocks are frequent, but models still need to provide reasonable directional guidance. Overall, the linear SVM showed improving accuracy month over month, reinforcing its operational suitability for near-term CCFI predictions, especially in volatile settings like global container shipping. In terms of contribution to the literature, this study confirms that machine learning techniques, especially the linear SVM, are valuable tools for container freight rate forecasting, offering high accuracy and the ability to manage complex, high-dimensional input data. It extends the research by showing that variables reflecting disruption, such as port congestion and geopolitical risk, are not only relevant but critical to improving forecast accuracy. This supports a broader move away from traditional macro-only models. At the same time, limitations are clear. Forecasting remains challenging in volatile periods, and the fixed 3-month lag structure doesn't always align with real-world shock timings. Errors observed during the early 2025 reinforce this. From a practical standpoint, the findings offer useful guidance for freight traders, hedging strategists, and logistics firms. For example, predictive analytics could help firms adjust FFAs or contract terms based on early warning signals like rising congestion or geopolitical instability. More broadly, this points to a shift toward data-driven, proactive business models. Firms that embed forecasting into their operations, whether for pricing, planning, or capacity deployment, can gain a strategic edge in a volatile market. Building on the findings and limitations of this thesis, there are some promising directions for future research. First, while this study relied on monthly data, using higher frequency inputs like weekly observations could improve the model's sensitivity to short-term events, such as geopolitical disruptions or congestion spikes, if such data becomes more widely available. Secondly, instead of applying a uniform lag to all predictors, future models could implement variable-specific lag structures. Some indicators may have immediate effects, while others influence rates more slowly. Approaches like the ARDL model could better capture these dynamics. Extending the out-of-sample forecasting window would also help test robustness across different market regimes, especially during periods of high volatility or crisis. From a technical standpoint, future research could explore newer model architectures such as temporal convolutional networks, transformer-based models, or even fine-tuned GPT variants for time series forecasting. Lastly, experimenting with different k-fold cross-validation settings could help improve the balance between model accuracy, stability, and computational efficiency. All of these advances, when combined with real-time data and operational expertise, could lead to significantly more resilient and responsive freight forecasting tools. To wrap it up, this thesis developed and tested a machine learning framework for forecasting container freight rates on the China-Europe route. using a rich data set that includes macroeconomic, operational, and disruption-sensitive variables. Among the 6 models evaluated, the linear support vector machine stood out for its accuracy, stability, and interpretability. The future importance results, especially through SHAP, confirm that key predictors like the lagged CCFI, interest rates, and port congestion are critical to anticipating freight rate dynamics. The model also demonstrated reasonable out-of-sample performance even in a volatile period and adapted better over time, which is crucial for practical forecasting. Overall, the findings reinforce that machine learning models, when carefully constructed and applied, can significantly enhance forecasting in the container shipping industry. They not only contribute to the academic conversation on freight modeling, but also offer practical value for decision makers managing contracts, capacity, and pricing in today's uncertain market. This concludes my presentation. Thank you very much for your attention and for watching.